Most transfers to or from a corporation are considered from the perspective of the capital of the corporation and the income tax consequences that attach to that. However, in situations where you have a corporation as a donor or donee of a gift on paper in excess of any value that is exchanged, then the corporation may be ignored so that the shareholders of that corporation are treated as either donees or donors of the gift. So, when we analyze this, you need to look to the standing of the individual who's making or receiving the gift. If they're an employee or a shareholder, either before or after the gift, then that gifted portion would be the amount that exceeds any consideration received or taxed to that individual, or any amount they may be entitled to receive from the capital or income of the corporation. Now, this analysis doesn't apply to a bona fide sale. This is only for a gift that exceeds full and adequate consideration. But consider that capitalization exchanges in family entities, in other words, transfers to an entity in exchange for an interest in the equity, may not qualify for bona fide sale treatment. The IRS looks on those with disfavor. And a similar analysis, as with corporations, can apply to an LLC or partnership, but with an added look to the treatment of capital accounts after the gift. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode 188, we're just digging into the concept that corporate transfers may invoke a gift tax. Now, this is often ignored, but it could become more significant if the gift tax applicable credit is reduced based on a credit equivalent of $1 million under tax proposals. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you'd like a copy of these slides, please email me at griffin.bridgers@gmail.com. Now on to the presentation. So, when we think of the gift tax in general, or gifts in general, we typically consider gifts to be between individuals because it's only individuals who are capable of forming the intent to make a gratuitous transfer. Entities don't have that level of thinking or judgment unless AI continues the way we think it might continue based on current development patterns. But that aside, when you have an entity in place, such as a corporation, the corporation can't necessarily make a gift because it doesn't have that intent, but there may be a deemed gift to or from the shareholders of that corporation, depending on the standing of the individual donor or donee of that gift. And that standing of that individual is going to drive whether you apply just an income tax analysis or just a gift tax analysis or both. So what do I mean by standing? Well, when you have a situation where property is transferred by a corporation to an individual, by default, the gift tax regulations treat that as a gift from the shareholders. However, those regulations also ask you to look at whether that individual is also a shareholder. And what's not mentioned in the regulations is also an analysis of whether the individual is an employee. And in my opinion, that's where your analysis should start, because if you have a transfer from corporation to an employee, the IRS default is going to be to treat that as a compensatory arrangement, and it's going to be difficult to get into an analysis where that could be a gift, because the IRS wants their hands on the income tax that comes along with a compensatory arrangement. Now, if you have an individual who's not an employee but is a shareholder either before or after the transfer, you also need to look at whether the transfer to that individual is disproportionate. So, if they only receive a portion that's attributable to their proportionate interest in the dividends or a return of capital, that wouldn't be a gift, but any amount over that threshold would be a gift. So for example, if you had somebody who was a 25% shareholder and they only received a dividend that's 25% of the income, there is no gift. But if they receive more than 25% of the income, in other words, if there's a disproportionate dividend, there might be a gift there. Same might hold true for a disproportionate distribution of capital on liquidation or redemption. When you're making a gift to a corporation, often This is analyzed from the perspective of being a tax-free contribution to capital. And that's the default income tax treatment, especially for a shareholder who's a shareholder after the transfer. However, that transfer might be treated as a gift to the other shareholders under the gift tax regulations, especially if the transferor themselves is not a shareholder or does not become a shareholder. Now, even if that individual is a shareholder or becomes a shareholder, there could still be a gift to the other shareholders, but what you need to do is determine whether the gift exceeds that shareholder's post-gift proportionate share of corporate capital by share class. So in other words, does the gift increase the share ownership of that transferring individual, and does it dilute the interests of the other shareholders? If not, then it's likely you're going to have a gift. And that would especially be the case in a situation where you have a family-owned corporation. Now, we only get into a gift analysis in a situation where there's no bona fide sale, or where there's a transfer in exchange for something else, but it's an unequal exchange. In other words, you're looking at the recipient receiving or giving more than full and adequate consideration. And in family situations, it's important to note too that on its base level, when you contribute capital to a corporation in exchange for stock, that seems like a bona fide sale, an equal exchange. But the IRS casts a lot of doubt on that in a family situation. They've taken the position that just a bare capitalization exchange may be presumed not to be a bona fide sale. In other words, the shares received or the interest received may not be full and adequate consideration. Now, that's usually more the case for an LLC or a partnership than it would be for a corporation, but that's still something to be aware of in a situation where there's a transfer to a family entity. And even if there is a bona fide sale, you have to make sure that the transfer to the entity is proportionate to the value of the interest received. Otherwise, you might be making a gift to the other shareholders. So in other words, if there's an existing ownership pattern that doesn't change, there's probably a gift. But if there's any sort of dilution of the other existing shares of individuals who do not make a transfer to the entity, that's more an argument that there wasn't a gift in that sort of situation. Now, a sale to an entity in exchange for other considerations, such as a note, may also follow a similar analysis, but if there's already such an exchange in place, you may also want to look to whether you can argue that there is a purchase price adjustment if a transfer is made or received down the road. And if so, you're going to have to amend that note to reflect the new purchase price, but that purchase price adjustment may relate back to the original sale date and may not be an income or gift tax event. Now, a lot of you are asking, what about an LLC or partnership? It's so rare we use family corporations anymore. And the good news is that you can use a lot of the same analysis, but the bad news is that there's a lot more depth to this than warrants its own subpart in this discussion. This could be its own standalone topic just because the IRS has really looked closely at family LLCs or partnerships due to the potential abuse of discounts for transfers of interest in those types of entities and the use of those entities as a conduit to avoid gift tax. Now, the big difference between an LLC or partnership and a corporation is that an LLC or partnership is usually a pass-through entity. And even though an S corporation is a pass-through entity as well, you typically have proportionate share ownership, which isn't necessarily the case in an LLC or partnership. Instead, what you do within an LLC or partnership is you really track ownership at the capital account level. Every owner has a capital account which is increased by contributions or decreased by distributions with respect to their equity ownership interest. So, with an LLC or partnership, the general analysis, which we'll develop in a later episode, is really just looking at whose capital account is credited with the contribution. If it's just the donor, there may not be a gift, but you may need to readjust shares to reflect the new percent economic ownership. Now, if all members or partners have their capital accounts increase, then you can bet your bottom dollar that's going to be a gift. in the eyes of the IRS. So when it comes to drafting an LLC or partnership agreement, it may be a good idea to always include language that by default credits the donor's capital account with contributions unless indicated otherwise. So lots of things that can come into play when you have a family entity in place. And we didn't even get into some of the situations that can arise with a service partnership within a family. But like I said, that's a discussion for another time. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.